Trust is something that was poorly explained to me when I was doing business. And so I've really tried to sort of step that up to give people more of an overview about how these things are and how they work. And so I don't go into quite the depths of the sort of the quirky natures of the fiduciary duties. We do talk here about how they work at a functional level, because trusts are things that come up. They are a real factor of contemporary legal and accounting practice, and you need them in both worlds, and it's helpful to at least get a reasonably good handle on how they work from both worlds, so both the accounting sort of side of it and the law side of it. Trusts and trust law is grounded in this area of law known as equity. As such, the rules aren't quite as hard and fast, and of the three sort of alternate entity types that we look at for this subject, last week was partnerships, next week is companies, and this week is trusts. This is the one which is a little more arcane. The rules are harder to understand, trickier to get your head around, and it's because your conduct matters. How you do things impacts how the way things go in court. They have things called the principles or maxims of equity that, to use gendered language, he who comes to the courts of chancery or comes to the courts of equity must do so with clean hands. You can't be trying to do something awful to the other side and expect to get a remedy in equity. And because trusts are grounded in equity, that makes this area a little bit daunting for people that haven't had the experience, the knowledge built up through the knowledge of the law. So without further ado, in a very basic sense, in our legal system, and only our legal system, you can separate the good bits and the bad bits of owning property. Because when we think of property as being a packet of rights, this is true. This is true. And Claire, when we were doing business law, we would look at property rights. This idea that you get this packet of rights. So, Stacey, what are some examples of rights you get when you own property? What do you get to do? What are legal things you get?
Oh, don't put me on the spot. I don't know. Like you get the right to do stuff to the house, to the property. Is that correct?
Yeah. So if you've got a house, for example, so we use the phrase real property to describe land and things attached to it. You get the right to occupy it, to have possession. You get the right to exclude others from that. You get the right to waste it. If you want to tear your house down, go right ahead. You get the right to sell it. And you get the right to create lesser grants to that piece of land. What's an example of that, Stacey? What's a lesser grant that you can create?
I want to say renting it out.
You'd be absolutely correct. You can lease, you can both license, in other words, let people come in, all right, for a particular purpose. Hey, come in for this board game night. If those people decide they just want to stay there for 6 weeks, they've breached they've breached the underlying license to use such things. But you can also create burdens on the land. So you can have both registered and unregistered leases to it. You can mortgage things as well, use it as security, the stuff. You can lend money on risk of losing the title to that piece of land. These are things you can do with it. But if you think about it though, flip that around. If you own a house, what are the burdens you have? If you're a homeowner, is it all rights and all sunshine and rainbows and ambrosia? Claire, you're a homeowner, I believe. What are the downsides of being a homeowner? Rates. Got to pay rates. If it's mortgaged, what else do you have to do? What do most mortgagees insist upon when they get you to sign the thing? You have to, starting with I and rhyming with literally nothing else in the English language, you have to insure it. You have to insure your house. Now, you don't technically need to if you own it. So my house, just by the quirky nature it's set up, I don't need to. I don't technically need to insure it, which is really weird in the according to the mortgage instruments. But I do need to insure it, as we'll look at case of Pateman and Hayham, which we'll look at a bit later on. I do because I'm actually the trustee of a trust in regards to that. Trustees must insure trust property. You have to pay rates, you've got to repair it, you've got to clean it, you've got to stop it from wasting. You have to, situations where things that are on your land are damaging others. You have to compensate people who are injured when they're on your land in the general law, tort of negligence. If you have, booby traps or whatever and big holes on your land and somebody comes in, you can be held liable for those things. So there's a variety of rights that you get, and there's also a variety of responsibilities. And what we are doing in trust law is splitting those two things out, because it's really trite with a piece of property that's trivial. Here's my water bottle. All right, have my water bottle here. You or I can own a water bottle and we can enforce our right. So if Stacey has my water bottle, I can demand it back. In theory, I could trot off to court and sue her for what tort? If you refuse to give my thing back, what's the tort called? It's called the tort of detenue. Bit of a strange word, but you get a right, an automatic right to just ask. If you have the immediate right to possession and you can demonstrate to the court you have that right and you've asked for the thing and they haven't given it back in a reasonable length of time, you can get compensation. So that's the tort of detenue. It's another right you get. Now, that's trivial for one of us. However, can 2-year-olds own property? If you are 2 years old, can you own stuff in our legal system? I'm not going to do this as a poll because there's only 3 of us. I reckon yay or do I reckon nay? There's no, well, yeah, they definitely can. Definitely can own stuff. There are buts. All the buts are they can't physically do anything with it. What are they going to do? Rock up to court? Imagine that little baby running to court. Oh, I want to sue someone to get my water bottle back. You can't do that. And so our legal system has taken this into account for 1,000 years. The idea of being able to separate the burdens and the benefits. And so you can split these things out, and you've got a lot of flexibility in doing so. Now, because you have so much flexibility, trusts have a little bit of a reputation for being something of a tax dodge, and they're not wrong. They're not wrong. Well, sort of. The thing is with trusts, if we think about what you need to have for a trust, the key requirement is you have to have stuff. So you're not really separating. When we think about us with personal services income, poor people that don't have assets but can have personal services income have to pay income tax, which is, whether that's fair or unfair, well, maybe not. In order to use trust, you must have property, and as such, only in theory, only wealthy can go through and use this. That's the challenge that we have here, why they have that reputation. However, you guys, in the course of your life, are going to accumulate. You're going to hopefully be good with your money and save, and you're going to have property. And also doing the discipline of accounting, you're possibly going to be advising people as well in regards to that. So when we separate legal and beneficial title, or the bad bits and the good bits of owning property, this separation is called a trust. And from that point, when that thing gets separated, the person who is the trustee usually is referred to with this language. So the trustee of, or first trustee for, the something or other trust. Okay, in regards to that. That's how the person is referred to. They are wearing a separate hat. A bit like, if you're a company director, you're wearing a separate hat. The things that you do in your private life and the things you do as a company director, they're two separate things, really, as part of that. And so that's what it is with trustee. But the trustees are the ones that are vested with legal title. They're the ones that are the trust, so to speak. And in terms of third parties dealing with it, because trusts themselves are not legal entities. So like partnerships, they're not legal entities, but we can, for the purposes of taxation, treat them as notional entities. You will do, if you have a trust and it either carries on a business or derives income in Australia, you are obliged to do a tax return. And by you, I mean you as the trustee are obliged to do that. And if that is the case, if you have a business, and technically if you have a business, you're not actually required to get an ABN. hilariously, but you'd be crazy not to, because there's a variety, there's a huge list of things you can't do. And the same with TFNs. You don't technically need to, as an individual, get a TFN. Trusts do, though. Trusts do. In order to file a tax return, you have to have a TFN. Okay. Otherwise, if you look, the reason why this comes about, and I don't know if I've talked about it in this subject, but I do for the advanced tax. Back in the 80s, I think, when the TFN system came in, when a vocal minority, a bit like the vocal minority at the moment, don't want to get vaccinated, want to be heard about it. Vocal minority are the ones that said, oh, we don't want to get TFNs. The government will just, next thing you know, the government will be tattooing it on your arm. Not kidding. This was the argument. Oh, you know, then we're all going to be numbers. They'll put them on our forehead, and we're just going to be slaves to the man. And while that sounds a little silly to us now, you know, people had genuine concerns. I mean, like they do about vaccines. I'm sure people have genuine concerns. And so what's happened, though, over time is that it's just been made harder and harder and harder, so that you sort of suffer, I suppose, so to speak, more and more for not having a TFN. So, for example, you can't have superannuation, you can't get Centrelink. Everybody that deals with you has to withhold a large fraction of the amount that they would otherwise pay you, and so on and so on. That's the sort of things that you suffer as a result. Anyway, look, from a practical sense, when you, I've got the creating a trust a little bit later, but when you go and set a trust up, an express trust for somebody else, you will create a deed. All right, that will map out all of the things that you need to map out. When you do that, you will also at the same time go and get one of these and go and get one of these. You'd be crazy not to at that time, but I'll talk about that in a minute. Trust is a large area of law, and it's hard to appreciate that this is both, all right, trust can be conceived in a variety of different ways. They come into existence in different ways, and it's only a subsection that are trusts as we think of them. The thing where you go to the accountant, that you sign a little deed, and then you have go and set up a bank account. That is an express trust. Okay, that's what we classically or conventionally as accountants think of trusts as being. But that's only part of the story, because trusts can also come into account when people die. They can come into existence upon death. Now, technically, when you die and you have in a particular instrument a set of instructions for your executor to establish a trust, what do we call that instrument? What's the written instrument that we...
The will.
Yay! She is paying attention. So in your will, it gives instructions to the to the executor to then go get the property and give it to the trustee. All right, put it in the hands of the trustee. All right, now we'll talk about this a little bit later, but for the purposes of tax law, when somebody dies and the executor is running around trying to determine what the property is and going through that process, it's actually deemed to be a trust in itself. So an estate at tax law is deemed to be a trust, even though it's not a trust in the general law at that stage. So the way that we usually talk about for the purposes of advising your clients in creating trusts is what we call inter vivos trust or living trust. They are ones that are done while people are still alive. Okay, and if you are intentionally, willfully going through to do that, that is an express trust. You're intending to go through and do that. Because, kind of unfortunately, you can have situations where trusts are created unintentionally. You almost always not through the desire of one or more persons. They can be used by the courts as a remedy, because trustees don't have to be voluntary. If there is property, you can make someone, the court can make someone a trustee, even though they don't want to be. That is why trust law, and the same rules that we talk about in terms of these strong fiduciary duties, can be used as remedies when people do, and I don't want to phrase it any more delicately than bad things. For example, if you, for example, let's say you have one elderly parent, that elderly parent lives in, say, inner city Sydney and has done lived there since 1961, and that house is now ballooned in value, and you've got kids, you've got a new partner. This happens a lot, by the way. It's quite sad. So they need a bigger house, and so you go to them and say, hey, how about I'll sell up here, we'll go and buy a bigger house out in Western Sydney, and I'll live underneath it in a granny flat until I die. We'll put the house in your name, and that'll save all sorts of drama. That way I won't need to go through, and you won't be able to contest wills and other bits and pieces. Does this sound like a reasonable thing to do? And can you see any problems with this?
Then they kick the grandma out.
Then they kick the grandma out, and what often involving the new partner. The new partner's like, oh, I can't live with this, and they have falling out. And you appreciate that when you're moving in with your kids, you're quite different to them by the time you're moving back, and they've got kids of their own, and life gets in the way. You get fights. You also find that people start to get a bit senile as well, so they get hard to live with. But you've got these awful cases. Now, what's the trouble with this? Well, the house is in the daughter's name, so ultimately they have full legal title. You've contributed some purchase monies, or you've contributed something for a particular purpose, and each of those situations, the courts can grant a remedy to place a trust upon that fraction of that house. So that's something that you can go through and do, and they are called, in that situation, those are called constructive trusts. In that situation, you can also have, and this is a bit of a doozy, you can have a situation where money is placed into an account for a specific purpose. Okay, that's this. And I'll give a case example here. There was a company called Rolls Razor, and they made razor blades. They borrowed money from a lender called Quistclose Investments. They borrowed money to pay some dividends. Now, we know, because we've all done company law, you can't do that these days, but that was the specific purpose the money was borrowed for. And it went to Barclays Bank, and it went into a particular bank account that was set up for this express purpose and labelled accordingly with Barclays Bank. And what happened after the money was transferred? The company went to liquidation, which meant it was statute barred from paying dividends. And Quistclose, the lender, were able to go to the court and argue that money was not part of the general funds available for the creditors, which one of whom was Barclays Bank. And look, they controlled the money, so they were just like, oh, well, we'll just close that and put it back in the rest of our pool of money. And Quistclose were actually able to argue that this money was actually held in trust for a particular purpose. The purpose had failed, and therefore it should result back to the settlor, being Quistclose in that case. And they won. And that's a little bit tricky to get your head around because that's a commercial arrangement. And usually these sorts of commercial arrangements don't have those situations, but it is possible to have or to argue that money is held in trust in certain situations. Okay, so those are trust through operation of law. I don't deal with trust through operation of law. Not sure we'll put it in the assessment or not. Maybe not. But it's something just to be mindful of that can actually happen as a remedy. Okay, right. Going back to express trusts, when you go and think of this from a practical perspective, you're rocking up to the accountants. And this is why it's important for you guys as accounting students to learn this stuff, because by and large, these sorts of trusts are set up by accountants, not lawyers. So just be mindful that you may end up doing this. And so this knowledge, you're not going to get it again unless you go and do a law degree. So it's worth just tucking some of the stuff away. So where you've got a trust, or rather, you've rocked up to the accountants, you want to set up a trust. There's two modes or styles you can have as part of that. The first is called a fixed trust. That is where each year the beneficiaries, the list of people getting the benefits of this property at some stage, are going to get a fixed amount of income, and a certain proportion, but they must get it every year. That is a fixed trust. They also get a fixed amount of the capital. So say, for example, the four of us, let's just say, Steve Graw's over there. So say Steve's just given us, I don't know, $400,000 to put in trust. If it's a fixed trust, the four of us are the four beneficiaries. Every year, the four of us are paid 25% of the amount of income, net income of that trust. Okay, that's a fixed trust. The money must be paid out. The trustee gets no discretion. So you can imagine what the difference between that and a discretionary trust is. In that situation, you do not get the right as the beneficiary to demand money be paid. You only get the right to ask for money to be paid in a particular year. You can ask to be considered for a distribution. You get a bunch of other procedural rights too, but that's all you get as part of that. If the trustee doesn't want to pay the money, the trustee does not have to pay the money. Okay, another distinction that we can make is where you have a trust which is for the benefit of particular beneficiaries. That is private trust. Okay, if you have beneficiaries, and you actually don't need to name the beneficiaries. You can have an open-ended class. For example, I leave this, and this is quite a common thing, to my child and all of his children. Probably a bit harsh given my child's 11, but that's perhaps not a great one. You could create a trust that you leave it to the everybody in who owns, I don't know, even numbered houses on Latrobe Close in Douglas, Queensland 4814. You could do that if you wanted to, and that is a class of persons rather than a fixed list of persons. You're okay, you can do that. It's still a private trust. However, you can also create trusts which are to fulfill certain purposes. And those purposes are benefiting the poor and disabled and decrepit, for the advancement of religion, the advancement of education, for other beneficial purposes. There's actually a fifth one, which is for the in Queensland. It's for the provision of recreational and sporting facilities. That's a defined statutory category of charitable purpose. In those situations, you don't need to have a list of beneficiaries, and there's a bunch of other things which are a little bit easier as well. Private trusts are limited to a maximum of 4 trustees, whereas and they must make decisions unanimously, whereas charitable trusts, you can have they make decisions by simple majority. So you don't have to find a particular beneficiaries to pay money to. It goes towards particular purposes. We don't really need to know too much about that here. Okay, express trust. You need to have 3 things for an express trust. You need to have a settlor, the person giving stuff away. You need to have a person who's getting the stuff, and you need to have a person who one day is going to receive the benefit of that. Now, technically, from this point onwards, I'm not going to refer to charitable trusts, because technically charitable trusts don't need beneficiaries. They're just there for particular purposes. So we're going to park that one aside and just be talking about express trusts for the remainder of this unit/topic. And in order to have an express trust, you've got to have those 3 things. Steve Graw's notes are excellent, by the way, and I do recommend you do have a read. They're on LearnJCU. Now, this idea of needing to have this 3-person relationship is it's critical, because they can't be the same person. Why? You've got to give stuff away. the settlor can't also be the trustee. You have to give things away in order to create the trust in the first place. And the beneficiaries, curiously, or maybe not that curiously, where you've got a settlor, they give stuff away to the trustee. All right, and then you have a beneficiary. Now, if you have two beneficiaries, that's going to be fine. B1 and B2. Okay, absolutely fine. Provided the only trouble that you'll have is if the list of trustees is exactly the same as the list of beneficiaries. If they are all the same persons, this is, I guess, important from a legal perspective, you can't separate the legal and the equitable title. You can't do that in the system. They have to be separate. But the courts have said you only have to be different by one thing, or one person. So, for example, for my own discretionary trust, I am the trustee, and my child and myself are the two beneficiaries. Now, because those are two separate lists, even though we're the same here, it's fine. It's fine from a trust law perspective, provided those lists are different. Okay, that's just the way trusts work. They just do. I couldn't just do it and make myself the only beneficiary. That just doesn't work. Okay, constitution is the point at which a trust is created. And the way it's created is when all the assets are fully transferred to the trustee. Okay, that's what it is. And so when you've got a settlor, that's at the point in time where the settlor has transferred the relevant trust property to the trustee. With testamentary trust, what you have in a will, it's when the executor is when they have fully transferred those. So when the executor, who's vested with title of assets when a person dies, it's when they have put that property into the hands of the trustee. They've done all that was able to be done at that point. That is when the trust comes into existence. That's the point in time. Magic point in time. Now, from a practical perspective, for a variety of silly anti-avoidance stuff, which I'll talk about a little bit later, it's this case here, this Truesdale case. In Australia, you'll find that when people create trusts, and Claire, you may be aware of this. Claire, do you have a trust at all? Have you had much dealings with them? Or Stacey, either of you, or Matt, if anybody's there? Has anybody had much dealing with creating these or managing them? Not really. It's quite common when you set these things up to just literally take a $10 note. Okay, so you have a deed, you have a $10 note. The settlor takes the $10 note, so this comes from the settlor, S, and just gives that to the trustee. That's all they do at that point in time. Now, if you have this, you'd be absolutely crazy in situations when you're setting a trust up to not use a deed. Why is that? You'll recall contract law. Remember a contract? We can make contracts that don't contracts don't have to be in writing. We remember that, right? You can make it an oral contract, or it can be a mix of oral representations or written ones. Now, if you do have a contract which is enshrined solely in writing, remember that rule, the rule about excluding all oral separate representations? Remember that, Stacey or Claire? Or Matt, maybe as well. Remember that? Yes, it's called the parole evidence rule. Good. So that's why it's the best evidence. You want to put things in writing. Also, there's going to be a requirement of writing, which I've probably got on a slide, but I think it's maybe the next slide, where things like real property must be in writing. So you'd be crazy to not do this thing in a deed. I've got a deed, which I can go and show you. I'll just, is there anything else here I'm going to talk about? Yeah, but it's not uncommon for this settlement sum to be merely $10. Okay, just a $10 amount when doing that. And if you're the accountant and you are going to be the settlor on a particular trust, you reach into your own wallet and you give $10. Now that seems a little unfair. And I told this story to the guys earlier that the trustee on my family trust, which is a discretionary trust, is my lovely but crazy vegan barefoot Marxist agitator friend Rebecca, who did an LLM, Masters in Laws, here at JCU. And I said, I'll buy you coffee if you come and be the settler on my trust. He said, ugh, you're just using it to cheat taxes because that's what everyone does with trusts. They're just vessels for evasion. Anyway, she doesn't talk like that. Sorry, Rebecca, if you ever watch that. This. Anyway, we arrived. She was barefoot, as she is. And I said, okay, right, we're here now. Here's a coffee. Now give me $10. And she's like, in very, very strong Germanic words, get out of here, Simon. I'm not going to give you $10 for your tax dodge, or however that was expressed by a true North Queenslander. And so I said, if you look just behind you, there, and just around the corner, there may be a bag of coins, and it may or may not have $10 in it. You just find that, and you just give that to me. Okay, that's how that worked. And so the idea is that you are you as the settlor give a token amount away, because once you've created the trust with the token amount, you can go through and do all the formalities of it. Then at a later stage, transfer in the assets into the trust, and that's what I had done. It's part and parcel of this. Now, an interesting point to note, and this is something I've just learned from mortgage brokers, is that it's because there's no system of registration for trusts, and every 10 years or so it becomes a political issue, and people jump up and nothing ever gets done about it, which is probably a good thing, because if I look at how the incorporated associations are managed, and yeah, in terms of registration, it's a waste of time. So doing this with trust would just be a waste of everyone's time. But no, maybe they could. But there is this sort of quasi-registration system where mortgage brokers and banks actually like the trustee to have been seen and a copy made in a government agency. And so you can, this is kind of funny, you can take your $10 trust and go and get it stamped, get it assessed for stamp duty. Because when you transfer stuff into a trust, you have to pay stamp duty. You guys are probably aware of this, right? We talked about stamp duty. What is the minimum amount, though, when you're transferring money in that you have to start paying stamp duty on? What's the minimum amount? Do you remember? Piece of information for you. You can move something into a trust. What's the minimum amount whereby you have to pay stamp duty? All right, this is a tax law subject. I've been quite intentionally putting the state taxes in this. So this is this is a reasonably important piece of information to know. What's the minimum amount? Not for motor vehicles, by the way. Motor vehicles is it's like $100 or something, but for anything else being moved into a trust, it is, oh, I guess is being hazarded. It's $5,000. So if you're transferring something into a trust, that is, and it's either the higher of the consideration paid or the market value of the asset. $5,000 moved into a trust, you must pay stamp duty. So with a nominal amount, a $10 amount, you go and get assessed, and they stamp it. They put a little stamp on the front of the deed, and what that means that it's been seen by a government agency. Okay, so that's one mechanism you can use in order to have some semi-registration. Does this make sense? All right. If anybody's watching this some stage later, you can feel free to rebut me on that. That's fine. It's practical things. You can. All right. Oh, I've got stamp duty here too. Great. There we go. So one thing to note when you're moving assets, if you're moving cash, it's neither dutiable nor does CGT arise as part of that. Okay. If, however, you are transferring either dutiable in regards to stamp duty or a CGT asset to a trust, and again, dutiable means in this situation 5K or more. I should probably use a greater than sign, greater than $5,000. If you transfer those things, then CGT and stamp duty are going to arise. Now, when you are transferring stuff in, there are a variety of exceptions that happen. And look, there's a couple of these things you really need to know because look, this has massive consequences. If you're advising people and you get this wrong, you will get sued and you will have to pay compensation. So this is probably worth tucking things away. Important one for the lawyers, and I guess I'd also say financial planners as well, is this one. Okay, when you transfer things through a court order after people have separated, no CGT, no stamp duty. When you are planning, it sounds awful when I said it, when you're planning your divorce, but when people are being advised on stuff, this matters. Stamp duty is quite a lot. When you're moving things around, you're buying and selling houses. A $300,000 house in Townsville, which is cheap houses by Australian and New Zealand standards, but you still got to pay 10 grand's worth of stamp duty. Or you can use know these rules and not. A couple of other things. If you're transferring into a family trust, there are a variety of exceptions by transferring assets into a family trust. Those are things that are defined in the Stamp Duty Act. You don't pay stamp duty as well in regards to that. Also, and this is a pretty important one as well, it's one thing to put things into trust. That's to put them in the hands of the trustee. So the trustee has legal title separated from the beneficiary. When the beneficiary asks for their share and the things are transferred to them, there's no consequences, no tax consequences to that. It's just the beneficiary asking for what's rightfully theirs. And so that part doesn't have any CGT or stamp duty consequences. All right, so I've mentioned this. This is the very minimum you need for any form of trust. Why? Not all trusts have a settlor and not all trusts have beneficiaries. However, all trusts must have a trustee, all trusts must have property, and to bind the whole thing together, the trustee has to know what to do. That's the sufficient certainty. It has to come through instructions from the settlor or the court in that situation. So that's all trusts must have those things. In regards to trust property, so going back to the certainty thing, the trustees have to know what the stuff is in order to know how to fulfill their duties in regards to trust property. Because trustees have fiduciary duties, they have to look after the interests of the beneficiary, but they also have particular duties unique to trustees, which is to take care of and maintain the trust property. So to do so, they must be able to identify what that property is. In situations where the court needs to be involved, the court needs to know what the property is to place all orders upon them. So if you can't identify the property, you can't have a trust. Note also that in regards to fixed trusts, you have to be able to know what and where the property is, how the income is going, and how the settlor has expressed it to be distributed as part of that. So you must know those things in order to fulfill. Trustees are status-based fiduciaries. What was the status-based fiduciary duty we looked at last week? It was partnerships. Partners are also status-based fiduciaries in regards to each other. Trustees are status-based fiduciaries in regards to the beneficiaries. They have general fiduciary duties, which is to not take bribes, not make secret profits, maintain confidence. But they also owe particular duties to manage, preserve the trust property, and to give it to the beneficiaries when asked, when they're legally entitled to it. Okay, I mentioned before that you can have unwilling trustees. They have the same duties as willing trustees. Only duties, not a lot of rights. They do have some rights, though. We'll get back to that. One of the things about fiduciary duties, you cannot delegate. You must act personally as a trustee. You can't, and look, this makes sense. If you think of other forms of fiduciary duties, you as employees, for example, you can't go and get your friend so the Easter bunny's just dropped off a bunch of eggs as well. I'm happy. If you guys are working at Macca's, you can't just get your kid brother to rock up, wear your uniform, put on a name badge, and just start working because you couldn't be bothered turning up. That's just not how that works. You must act personally regards to that. The same with company directors. The same with solicitors. Solicitors can't get the office lad to do legal work. You're just not allowed to. That's a breach of fiduciary duties. And so trustees have the same things. They can't delegate. They can get agents, which I think was the next slide. Oh, there we go. They must get competent agents. What's a competent agent in regards to accountants, lawyers, and tax advisors?
Someone who is also of that same caliber.
Yeah, there's caliber, but there's the key thing is you have to actually be registered. So you can't get your mate who calls himself a lawyer that have never been to law school. Now we know, because we've all done legal ethics, Stacey, that section, oh, have I got the Legal Profession Act? Section 5, I think it is. What does it call people lawyers? Meaning of lawyer, an Australian lawyer is a person who is admitted to the legal profession under this act or corresponding law. That is section 5 of the Legal Profession Act. If you do not satisfy section 5 of the Legal Profession Act, you aren't legally allowed to call yourself a lawyer. But people do that all the time. They just do. And so when you're employing competent agents, they must be registered and hold all of the relevant qualifications at that point in time. If you do that as a trustee, then you aren't liable for losses that are sustained as a result. Now, one thing about trusts and trustees in tax law is you'll hear a lot of this idea that the trustee pays the tax. This, I always thought it was strange when I heard, sorry, it's me coughing away. I always thought it was strange when I heard, whoever it was, Steve or whoever told me this, talk about the trustee paying the tax. Because, well, technically, yes, the trustee is obliged to pay the tax. In practice, when you set a trust up, first thing you do is go and set up a bank account. And look, occasionally this has come up through the courts where people have created trust, but charitable trust, for example, to fulfill certain purposes. So, I leave this house in Manly Beach or wherever it was, actually 2 houses, for the benefit of like seagulls or something, like for the benefit of local wildlife. But they didn't leave any money. So what do you do? What do you do in that situation? In that situation, you actually have to ask the court to see if you can sell the things, because you, as the trustee, you have all the duties to spend this money, to insure the house, to pay the rates, to pay the mortgage, to do those things. And technically, while technically you have a right to pay, you've got a duty to pay those things as trustee. In practice, you pay them out of the trust funds. So the bank account that you have access to, because you're the trustee, it's literally in your name. That's where it is. So that while you do have this right to reimbursement, usually you're spending their money first. So that's how that works. And note, if there's a situation where you're not sure, you can ask the court for directions or advice as part of that. You can always get the right to go to the Supreme Court and ask if you're not sure. The definition of partnership in the general law and in tax law is wider. So it includes the general law definition, but there's also extra cases. Same thing happens with trusts. So this definition of trustee is both the general law definition, so that includes express trust and those through operation of law, as well as executors. So that when you are the executor, that is deemed to be a trust, or you're deemed to be a trustee. So you've got to do a tax return. When you are the administrator of an incorporated entity of some sort, when you're the liquidator of a company, you are deemed to be a trustee. And also, when you are, or you have taken upon yourself, either like legally because you've been allocated, or because you've just through on the facts decided that you'll take over control of income affected by a trust, or acting in any fiduciary capability, or having the possession, control, or management of the income of a person under any legal or other disability. That's a super, super wide situation. If you are you're dealing with bank accounts on behalf of your, a, a child or a person in prison or a bankrupt, then in those situations, you're acting as trustee, and that, even though it might not be considered a trustee in the general law, you're going to be a trustee for the purpose of tax law. It means you've got to have a TFN, lodge a tax return, and explain where the income is going. That's the key thing you've got to go through and do there. Right, writing requirements. You need to have a will for a testamentary trust. I'm just trying to think whether you could form one. Have you done succession law, Stacey? Not sure whether you have.
I'm not really sure if I have, but it sounds really familiar. Like as soon as you said that, we might have learned about it in trust. Hold on, let me check my subjects. I can't even remember what I've done
Probably not.
anymore.
You don't remember trust law? You would have done with Tony Collins if you did. But I don't believe that you can set trusts up without a validly formed will. Regards to that in Queensland, but I'd have to go and check that. I don't remember, but I'm pretty sure that's the case. Oh, why don't I read the Succession Act, Section 10? We'll come back to that. Come back to it. Check it during the break. All right. However, as I'd mentioned before, when you've got doing things with real property, you can't have contracts for the sale of land unless they're in writing. You also can't assign things, so you can't have things like copyrights. You can't assign equitable property, so the rights to future royalties of things. You can't assign a whole bunch of these things and manage them without having things in writing. And if you are going through and doing them in a trust deed, you go and get them stamped. They've got to be stamped under the Oaths Act in order to go through and make them valid. And look, it's you may or may not be aware that for a variety of Commonwealth statutory declarations, you can get a wide variety of people to do this. Claire or Stacey, have you guys ever had to get someone to do that, to Commonwealth Stat Dec at any stage?
Yes, actually, I have.
Yes. Yeah. And the list of people that you can get to do it is huge. You can get a minister of religion can do it, a dentist can do it, a university lecturer can do it.
We did it with a police officer, I think.
There you go. Police officers can do it, nurses, teachers, accountants. So that is for Commonwealth stat decs, but it's not the case with the Queensland things. If it is under Queensland legislation, solicitor or JP. And to be honest, you should almost always get a JP to do it, get them to stamp it. You're just going to save yourself drama at a later stage. In fact, Steve Crawley was just here before, who is the JP himself, but he got me as also a JP stamped up because you obviously can't stamp your own documents. And there was one part where we looked at it and it required only a signature of a witness, but we both agreed that it was still, just to be extra careful, you put the stamp on it as well. You just do it, because sometimes you're going to be dealing with bureaucrats who aren't that bright. Just trust me on this one. If ever you're going through and you're doing something like that, and you're dealing with banks, because appreciate you're also dealing with, in situations where you're dealing with private entities, you aren't dealing with government agencies subject to things like judicial review. When you're going and getting a loan, you're dealing with a mortgage broker, and they'll say, no, you need to get it. No, it's got to be JP'd. We're like, no, actually, it can be this or it can be that. It's like, well, you've already lost the battle. So please, just as a piece of professional advice, if you are dealing with documents and you're not sure, go and get a JP to do it. Don't do it with anything else. It's just not worth it. It's not worth the extra drama to go through. So how do these trust things work from a dollar perspective? All right. So it's kind of similar to partnerships. you need to, okay, in some ways they're really similar, but there's a couple of gotchas where they're different. So the first step though is just the same. In order to calculate how it works in terms of beneficial interest and sending income out, you start by pretending that the trust is a resident individual, which means that they are taxed on their worldwide income. And they are subject to all of the ordinary statutory deductions that an individual would be able to have. Now, there are some things that are different from partnerships. So, when you are dealing with it, and you may recall this from the partnership stuff for those that remember it from last week, is that there are certain things that are intrinsically individual that apply to natural people, and things like capital gains that are just ignored, and carried forward losses that you don't ignore those things for. You just ignore those things for partnerships. We actually do take into account capital gains and carried forward losses in regards to trusts. So trusts can have carry forward losses. Okay, provided, this is important, and we'll do something similar when we look at companies next week, the beneficiaries haven't changed. If the beneficiaries have changed, there's quite a complex formula for working out what fraction of the carried forward losses can be applied to the various income streams for the current year. It's outside the scope of what we do now. Also note that capital gains on particular assets can actually be streamed to particular beneficiaries. So certain gains can go to certain beneficiaries. And so you do have the benefit for trusts that are closely held to be able to send particular amounts, capital gains and franked dividends in certain directions. Okay, note that like partnerships, if you go and you get all of your income, and then some fraction of it may be overseas, and some fraction of it may be Australian. Then once you've done that, you chop it up, and you, by default, unless the instrument allows for it, you then just send this income in exactly the same proportions out to the various beneficiaries as part of that throughout the year. But we'll come to that because yeah, that's the next step. So once we've determined the income of the trust itself, we then determine how this gets sent out to the beneficiaries. Now, it's a little bit more complex than with partners and partnerships. Partnerships are easy because when you're dealing with business and business people, they're all functional adults. You're sending things out. And last week we did talk about taxation of minors and what happens if you send or have minors as partners. And there's a whole bunch of punitive rates that go there. But with trusts, it's a little bit trickier because it's not at all uncommon to have situations where the beneficiaries, by their very design, can't do anything. I mean, what would happen if you gave a check for $10,000 worth of income to a 2-year-old? What are they going to do with it? Put it in their mouth? That would be pointless. So as a result, the trust law takes this into account. And so we have this concept of firstly what we call present entitlement. All right, that is where a person is actually allowed, according to the instrument, to have income for a particular year. That's the first thing we've got to look at. The other thing we've got to look at is what we call whether there's a legal disability. And the technical phrasing of this, people with legal disability aren't allowed to enforce their rights in regards to the trustee and payment. They can't effectively receipt the money as a result. So we have to look at those things. And look, we also look a little bit at residency. Residency gets a little bit more complex. So I've talked about it just a little bit, and yeah, we'll probably put a little bit of residency stuff in the quiz, but the residency stuff we do in a lot more depth in advanced tax law because it's quite complex when you've got non-residents, but also we've got non-resident trust assets. We won't have any situations where we've got non-resident trust assets here. Okay, so this first concept, present entitlement. In the simpler sense, that is where a person can demand, a beneficiary can demand the trustee pay them, or either pay them the capital or pay them income, or direct them to reinvest the money in the trust. So that's basically what present entitlement is all about. If you have a situation where you can do those things, then you are presently entitled. So there is a person, you may have heard of this person by the name of one Ms. Gina Reinhardt. What is Gina Reinhardt famous for, Stacey? Or Claire? Or,
I don't know. Oh,
you
maybe.
don't know.
Okay.
She's Australia's wealthiest person. Oh, Maddie's there as well. Hi, Maddie.
Oh, she. Okay, well,
Well, there you go. And she had 4 children, and they hate her. And so she had a family trust. Hi. And famously, this was about 7 or 8 years ago, had to go to the Supreme Court in New South Wales to have this thing heard. It was awful, absolutely awful. So if there's a piece of strategic life advice, don't spend all of your life accumulating wealth and spend no time on your kids, because not only will they hate you, they'll also be spoilt brats, which is effectively what this that whole thing was about. It's just awful. They're just terrible human beings, all of them. Anyway, so this happened where to do with what they call the vesting date, which was something like, oh, when the youngest child turns 31. And Gina, when the youngest looked like she was about to turn 31 and her children were spoiled brats, tried to extend that date, which is going to create a variety of other problems, which we'll talk about later. That was to make sure that they weren't presently entitled. In other words, they couldn't ask for their share of that particular trust, which essentially was going to be, if there were 4 of them, a quarter of the bulk of the wealth of Australia's wealthiest person. So it's a non-trivial sum of money involved here. All right, so this idea of present entitlement generally flows from the deed itself. It's the instructions of the settlor. This is where things are getting a little bit tricky. Trust law, good old trust law. Why? Why? Because if you are the settler and you put into the hands of the trustee a house, okay, here's my little house, and you can give instructions, and those instructions end up going in the deed. All right, so just say, oh, here's the deed here. Great. And you could put in these instructions. Okay, I would like this house to be held on trust for the life of Claire. On remainder, so in other words, after Claire dies, it then goes to Maddie. Okay, so it's C for life, and then M after C dies. Okay, that's called a life estate. So you've got some problems here, because assuming that Claire doesn't live in the house and it's just gathering rental income, all right? How and where does this go to? Well, if it was just as I've expressed it there, until this condition happens, Claire has a vested life interest. So in this situation, if assuming that it was a fixed trust, the income's to be paid every year to Claire. Okay, so that would mean she would be presently entitled to that. Great. Now, if, however, it was a discretionary trust, and the settler would choose, so when the settler is doing this, the settler gets to go through and choose as to whether or not it's going to be discretionary, D, or fixed, F. If it's a discretionary trust, each year Claire can ask the trustee, and let's say it's Stacey's the trustee, and Stacey can either say yay or nay. If it's a discretionary trust, she gets to choose whether to give that money or not give that money. So if Stacey makes an election to pay the money, then Claire becomes presently entitled to that income stream. If Stacey decides not to do that, then in a discretionary trust, she's not going to be presently entitled. Okay, that's just the key thing to note there. Now, Maddie is not going to be presently entitled until a certain condition happens. What's the condition? What needs to happen in order for Maddie to get money? Rental income from this house, where Claire has a life interest in it. What's the event?
She needs to die.
Claire needs to die. Sorry, Claire, but that's for the purposes of this example. That is the condition. And so Maddie's interest in this property does not vest. She does not become presently entitled until Claire dies in that situation. So that's it. So that is it's a conditional interest in that particular point in time. So that idea of separating the benefits, and look, it comes down to you with property. One of the things that a little known piece of information about property is that you can gift your property away. Okay, so you can say, oh, here's a house, here you go. However, you can also gift property with conditions. Here's this house, provided that you stay unmarried. Oh, that's not a very good example. Provided you live in it. Okay, so you can gift people stuff, and that is actually okay. We call that, and you can do that. That's not an equitable thing either. That's a common law set of rules. You can gift things with conditions. We call those powers of appointment. Those things there. It's a conditional gift. Now, that's different from a trust. Trust, remember, the trust is where you're holding something for the benefit of somebody else. That's a different thing again. And so as a result of being able to do this, and people do, and the reason why this law sort of comes up and comes to be, you're going to laugh, it's to do with incompetent children. The law of incompetent children, where you have situations where you know, maybe the matriarch or patriarch of a family, probably all matriarchs, I would think, given the people that are currently in the virtual room, and your children could be idiots, just total idiots, who have no concept of money, spoiled little brats, what have you, but you want the family estate to to be passed down through the line after you die, so you can create these life tenancies, which then pass on to the next generation rather than pass on to your children, because otherwise your children do stupid things like sell the house, chop it up, burn it down. So that is a mechanism where, to some extent, the dead can control the living. We don't really like that. We don't really like the dead being able to control the living. But to some extent, it helps because it gives people the incentive in their life to work hard and to create wealth, knowing that it's going to go to keep their offspring happy at some stage later. Does this kind of make sense? It's think of Jane Austen and things like that, where you've got family estates in ye old England being passed down through the generations, and you have to be fearful of your own children just being woefully incompetent, and that's how they can have systems that that work their way around that. If you are presently entitled to money, to income streams from a trust, and you're not under a legal disability, that amount, regardless of whether it's paid to you or not, becomes income, and you must pay tax on that. So, for example, I've created this, I'll say, Steve Gross created this trust for the benefit of the four of us. In this particular tax year, there's $40,000. If it was a fixed trust, regardless of whether money's paid or not, $10,000 is going to be added to your income. You must record that, and trustee is obliged to record that, say who all the various people to, and if you don't do that in your own personal income, something's going to happen. You get a knock on the door from the ATO. Now, if you are allocated income, one of the things as a beneficiary you can ask for is to actually be paid. You get the right, if income $10,000 is allocated, you give me the $10,000, please. That's something you are allowed to ask. Okay, so but the key thing to note in regards to the trust and the trustee is the trustee doesn't need to do anything else. Once the person is presently entitled and not under legal disability, they don't need to do anything. That's it. When they're filling in the tax return, allocating the money, and so on, that's done. They don't need to withhold tax. They don't need to send anything to the ATO. Okay, now in situations where they don't pay the money, that can be something of a problem. The reason why it's something of a problem is that it's not a debt. All right, it's an obligation in equity, not a common law. What does that mean? A couple of things. One is that if you become bankrupt and money hasn't been paid to you from a trust, the trustee in bankruptcy can't grab it, okay, because it's an equitable right to be paid. They can't make you get the money off the trustee. All right. The deemed dividend rules don't apply. So if you do have a situation where you've got the trust, you've been deemed for this $10,000 to add to your income because you're presently entitled to it, but if it's not paid, it's not a deemed dividend. All right. If you decide to just let it go, if you say no, I forgive this particular obligation, carry on. The trust can keep that $10,000. However, because people have gone through and had a variety of systems in place to try and avoid paying tax, it can be deemed a loan under the company's anti-avoidance mechanism. So if you've got that $10,000, but instead of you being an individual, if you're a company, it can be deemed to be a loan back to the trust. Why does that matter? Well, it means that you've got a variety of mechanisms that can have deemed interest in regards to that. You can't write it off as a bad debt as part of that and get a tax deduction. But probably the most important one for our perspective is this one here. If you don't get paid and you just leave it with the trustee, it actually is a CGT asset. So even though it's not a debt at common law, so it's not a common law obligation, the CGT regime doesn't care. From that perspective, it's just created an asset worth $10,000, and thus you, when things happen to that and it's disposed thereof, say for example you just write it off. So you go, you forgive that particular amount and say, oh, that's fine. Trust, you can keep it. Trust. Then you've just disposed of a CGT asset, and so that's a disposal. So that's a variety of things come up from that. Okay, Claire is mud at this stage. So you've got present entitlement. The next thing you need to look at is whether a person is under a legal disability. That means they can't enforce their rights. They can't actually do anything. So telling them, oh, you've got $10,000 in this trust, it doesn't mean anything if they're in jail. They can't do anything about it. They also can't do it if they're bankrupt, if they've got a serious mental illness or they're intellectually disabled, or if they're 2 years old. That just doesn't work. And so that at law, we categorize these people for the purposes of income tax trust law to be under a legal disability. They cannot effectively receipt the money. And when you've got a person who's presently entitled but under a legal disability, there's additional rules on behalf of the trustee. The main one is this one here. they pay tax from it. And usually you take it straight out of the income stream, but it depends what the instrument says. And they are paying that tax to the ATO at the beneficiary's normal individual marginal rates. What's the problem with that? What's one problem you can see right now? Guys, what do you think? So if you've got a trust, going back to the trust that Steve Gore set up for us, for the four of us, all right? Let's just say we're all under legal disability. All four of us are in jail, okay? All four of us are in jail. So as the trustee, we'll say, who can be the trustee? Who's the subject? Jamie can be the trustee. So if Dr. Jamie Fellows is the trustee for this trust, for the four of us, what does the trustee have to do here?
The trustee pays the tax?
Trustee is paying the tax, yep, at the beneficiary's normal individual marginal tax rates. Okay, what's the problem with that though? You can see. It should be a pretty obvious one. If we're all, yeah.
The marginal rates?
Yeah. Yeah. What's a problem with a trustee paying that to a beneficiary at their normal marginal rates? Can you see a problem that's arising?
Well, it depends on.
How does Jamie know what your marginal tax rate is? He has no idea. They have absolutely no idea what the beneficiary's normal individual marginal tax rates. You also don't know if, as a trustee, if they've got multiple trusts. So there's a couple of times you look at this and go, that doesn't make any sense. I remember the first time I looked at it, I was like, hang on, how do you know what that is? You just assume they haven't got income from somewhere else. So you're paying them, 18 grand, don't withhold any tax. So if you are in 10 trusts and you've earned $18,200 from each of those 10 trusts, none of those trustees are withholding any money because they don't know about any of the other trusts. So you're going to end up with a massive tax bill. That's just how it works with trusts. Just literally how that works. So I know if that seems silly, kind of is, but there's no other mechanism for doing it because there's no system of registration for trusts. Look, it's probably not a big problem. The reason for that is generally people under a legal disability don't have many trusts. Usually it's family members, and usually your family has only one trust, but that's not the case. And certainly moving forward, where you've got a lot more sort of separated parents and such like, it doesn't really make a lot of sense. So that was the point that I was just trying to raise there. You have to just guess as part of that. So if we'll put that in assessment, and I probably will, just note that when you are doing that, so say, for example, you're paying, each of us has earned, what would we say, $10,000, no tax would be withheld. If, however, each of us got paid, let's say that had a really good year, and we've been paid $50,000, all right, so if that was the only money we earned on $50,000, it's probably about $12,000 worth of tax. Great. So that is, once that goes into our income and it's been paid off to the ATO, that amount is going to be a credit. So assuming that we have got other income, we've got our own jobs and bits and pieces, if we're off earning money elsewhere, we will still have to add that $50,000 as income, but we'll get $12,000 worth of credit, tax credit. Note that it's non-refundable. Non-refundable credits as part of that. They're a minor. Remember the rules for minors that we had last week for partnerships? So if you have a minor, you've got a variety of punitive rates. The first $416 that you pay a minor is tax-free. Everything beyond there, I think the next $1,200, $1,300, you pay 66 cents to the dollar. And then everything beyond there, 1,372 or thereabouts. Everything beyond that, if it's paid beyond that, all of the income, including the first two brackets, so to speak, is paid at the top tax rate, which is 45 cents, plus probably the Medicare levy, probably. So it says 45, which is the top tax rate. But there's probably a Medicare levy in there somewhere. Okay, so because it's unearned income. Yeah, all right. That's what happens when you've got entitled, but people who are under a legal disability. Oh, this is the third part. So let's just say going back to this trust we've got. So we've got this trust. So we've got say it's made 250k this year. 250? No, 200. No, 200,000. All right. So this trust that we've got has made $200,000 this year, right? And there are 4 of us as beneficiaries. And if it's a fixed trust, $50,000 must. So there's Claire, there's me, there's Maddie, and there's Stacey. All right. If it's a fixed trust, it all has to be paid. Not sure, I'm going the wrong way. There's your share. All right. So it all comes out. Great. That's if it's a fixed trust. If it's a discretionary trust, the trustee gets to choose. So let's just say the trustee, it's Jamie's, not that happy with me because I haven't done enough work on this subject that we're supposed to be designing, and isn't happy with Maddie either. All right, and the trustee can do that in a discretionary trust, but still decides to pay Stacey and Claire, and we'll say just 50 grand. That's fine. What does that mean? It means that $100,000 is left over. Now, unlike partnerships, with trusts, you can leave that money, that income in the trust. You are allowed to do that. However, what is the disadvantage in doing that? What do we think the disadvantage of not paying money out to beneficiaries and leave it in the hands?
Tax?
Yeah, it's definitely taxed. And more importantly, it's taxed at the top tax rate. So if you leave money in the trust, you leave income in the trust and don't give it to beneficiaries, and that can be because a whole bunch of them are presently entitled. And remember, with discretionary trusts, you as the trustee get to choose this. You are the person that decides whether yay or nay to any particular person. So that's something to just be mindful of. You get to choose. So with a things are left in the hands of the trustee, top tax rate. Now, this can actually be remitted though. So this is kind of a punitive rate, but it creates all sorts of problems because some of the situations where people become no longer presently entitled, that can be really problematic. So here are some examples of the things that tax office must take into account when they're determining whether this particular amount of net income can be remitted to an individual's marginal rate. And so it's things like this. Income of deceased estates, so before the estate's been fully administered, so while it's going through that process of being administered. Income of deceased estate where the income's been derived, so the estate is still going on, but something has to happen before the thing can vest. So you've got beneficiary reaching a certain age, or now you can have this separate from there being a trust. So you can literally have in the instructions to the executor, when holding on to the, when winding up my estate, don't pay any money to Stacey until she's married. You can do that. All right. And the executor is under powers of appointment to not do that thing. It's different from a trust, but we know that the definition of trust for the purpose of tax law is wider than under the general law. Okay, so that's just something just to note there. Where a person dies during the tax year. So where a person's derived money in the year, all right, but that particular income has been is being held for the purpose of by a particular trustee for a particular purpose. And so, for example, if you're just working throughout the year and then you die, and then that amount of money is held on to, and it would be pretty mean to then tax that at the top marginal rate, and so they don't. If a particular trust estate, again, has a particular amount which is which is spent or applied, but it's applied to meet non-deductible expenditure. All right, and so that things that you would otherwise be spending money to go through and to do things, if it's applied for that particular thing towards things you can't get a tax deduction for, then they'll remit that to marginal rates as well. And if it takes you 2 years, which can take sometimes a lot longer than that, to wind the estate up. So a lot of these things, by the way, involve deceased estates. Deceased estate, when people die, because it's not really fair to on beneficiaries in those situations to tax them at the top marginal rate, because no one's presently entitled until the whole thing's been wound up. It's pretty common for that to happen. Okay. Yeah.
I just have a question.
Yeah.
Before, in the slide before, when you said trusts pay the tax.
The trustee pays the tax.
Yeah. Oh, a trustee. So,
yep.
Okay. So if the income gets left in the trust, the trustee has to pay the tax. Yeah. Okay.
Yeah, it's just and they're paying it out. Clearly, they're paying it out funded, probably out of the same fund. I've used the phrase representative capacity. That's not a legal phrase. It's not in the Act or in the things. But in practice, if, for example, going back to this example here, if there's $100,000, the trustee will take that particular sort of stream money, that particular account, and send a check for $47,000 after the ATO. That's how that would work. So they're not going to reach into their back pocket and pay and then try and get a reimbursement. Usually you'll physically just do it out of the same bank account. I wonder if I've got some examples here actually. I've got my own trusts. I don't think I have floating around, but yeah, it's on a should do. Hang on.
Yeah, sorry, I just thought it always had to be distributed. That's
no, partnerships do. That's one of the key differences between the two. Partnerships must be distributed. Trusts do not have to be, but usually, again, if no one's presently entitled, then they have to do it at the whatever the rate is. Oh, there we go. It's got bank accounts. I've got it. I probably don't need to show that on the slides, but it's one of those things where we're looking at the advantages of trusts. One of them is to keep things tidy, so that you as the trustee. So, for example, with me, with my house, I am actually the trustee. Now, it's actually quite common, by the way, and I'll probably add a slide to this. I think I'm going to just add a few tweaks. It's quite common for people to have corporate trustees, to actually set up a company specifically for the purpose of being the trustee. That's quite a common mechanism. I found when dealing with banks, it's quite uncommon for individuals to go through and do that. And so much so, like, I'm not making this up, because there's a mortgage on the property, I needed to be the guarantor. Okay, so I need to guarantee. So I'm personally liable for the debts if the mortgage isn't paid. Okay, and I'm the trustee. So the lovely people at Westpac, with their lovely, very well thought out document, said, I'm not making this up, the guarantor can't be in the same room as the trustee when doing the guarantee. I'm not making that up. That is actually Westpac Banking Corporation's rule. And so the staff members are like, I don't know what to do. So I was with a friend of mine who's a lawyer and sat outside the room, reached my hand in and signed it in the other room. Not even kidding. Good work, Westpac. And Also, they did take 5.5 months to give me a mortgage too, which was kind of a bit annoying. So that can, yeah, no, Westpac. Anyhow, when setting that up though, is setting it up with a pot of money, and so there's an account which is actually an offset account for that mortgage, and so things are paid for the trust. So me as the trustee pays for things out of that particular bank account. So rates, insurance, and the mortgage automatically draws down from it. And do you know what? And this is just a piece of life advice. Do you know what the best thing about this is? You don't have to think about it. It's just done. It's just sorted. Everything's just sorted. The house is just so easy. We can just live in it. I probably live in it with the money that's in the now for, I think I worked out like 11 years before I have to contribute to the mortgage. It's one of the aspects of trust which is really understated is tidiness. And if you guys are tidy people, using trusts to manage your affairs, it's good on the brain. I know it sounds like a very silly or a small thing because there's a variety of tax reasons, and then I've got a slide on it later on. But it's certainly a mechanism that you can use to keep your affairs in order. Okay, non-resident beneficiaries. Again, look, you may or may not be aware when you're paying things to non-residents, there's a bunch of withholding rules. You've got to do that. But, and this is the cute question, non-residents are only taxed on Australian source income. So if the instrument doesn't say anything about sending particular streams to particular people, so for example, if you had an instrument that says all of the foreign income goes to foreign residents, that's fine. Then you just follow that instrument. If you don't say that, then it's proportionate. So going back to the example where we had there of the 200,000, let's just say we've earned 200,000, right? So we've earned 200K, and there's the four of us. But we'll just assume that Stacey is overseas. So Stacey, here's Stacey there, she's overseas. And the rest of us are all resident. If this $200,000, if it was say 180,000 was Australian and 20,000 was overseas, when it's paid out, if the instrument is silent, it's paid out proportionately. So each of us is going to get $50,000, and of that, let's do the numbers. 45,000 is going to be Australian, and 5,000 is going to be foreign. 4,000, 5,000, yeah. Does that kind of make sense? Because that would be the proportions of the Australian source versus the non-Australian sourced. And so that if the instrument is silent, if the instrument lets us send the income streams where we like, we would probably send this 20 to Stacey along with another 30,000, and she wouldn't have to pay tax on that 20 because it's foreign sourced. She'll only pay tax on the 30. And from our perspective as residents, because the residents pay tax on their worldwide income, doesn't make any difference whether it's foreign or it's local. So that's just something to note there. If the instrument is silent on it, it must be done proportionately. If the instrument allows the trustee to pay certain streams to certain people, stream them, so to speak, then that's completely fine. Okay, and that's what I've got as the final slide there. All right. Oh, streaming. There we go. Now, in regards to capital gains and frank distributions, it's a little bit more complex. The rules are actually, if you go through and read them, are very, very complex. A couple of things to note here is that if you have a capital gain or a franked distribution and you want to send it to a particular beneficiary, you can. However, there are a couple of additional hurdles. It has to be referable. So a particular beneficiary, right, must be referable back to that particular capital gain. In other words, there has to have some reason for doing it, all right, which is more than merely for tax minimization. Must have some association with it, and it has to be recorded. Record its character as part of that, because it's to do with the underlying nature of the income stream. You've got to demonstrate the connection. So unlike with foreign income, where you can just pick and choose, if assuming the instrument says so, if there is a capital gain on a particular asset, you have to, say for example, Stacey's got a bunch of capital losses, all right, and we've got and sold a particular capital asset in the trust. We have to demonstrate some connection in regards to her, in regards to that, and then record that. That's how that works. Okay, big difference between partnerships and trusts is you can't send losses to beneficiaries. You just can't. Okay, it can't be allocated. And so as a result, you can carry forward those losses. You can carry them forward, but if the beneficiaries are the same, all right. So I phrase this in the positive. If the beneficiaries are the same, all good, all is fine and good in the world. If the beneficiaries aren't the same, I didn't say that you can't do it. It's just really complex. It's got a complex formula that's in there. I'm not going to a great deal of depth. We have to do something similar with companies next week, so we'll probably explore that stuff there. This stuff is already complex enough, and I don't think it's worthwhile. So if the thing comes up, I'm not going to ask you to apportion them. They'll either be the same or they won't be the same. Does this make sense, by the way, in terms of losses? Trusts, if your trust is making a loss as the trustee, you're probably doing something wrong, because the whole point of trust is they're supposed to be low risk, low return investments. Okay, look, if you change a trust, you've got to think about this. We've got the four of us as beneficiaries on this trust, all right? So we've got this trust where the four of us are beneficiaries. If we or the trustee decides to add in an additional person and or kick someone out, you're changing beneficial interests. They're going up and they're going down. And as a result, that's CGT event, either a gain or loss or disposal. So as a result, if you are making, more than merely minor changes to a trust deed, those things, they've listed them there in that tax determination, changing the vesting date, changing investment powers, having new definitions, adding and removing people from the general beneficiary class, changes to the identity of the trustee. So something which is fundamental about the identity of the trustee, not merely changing the names of the trustees and changing who it is. If you're changing what it is, so if the identity of the trustee changes. So, for example, if you change the like a corporate trustee and you change it to an individual, that wouldn't really work. If you change the nature of the constitution of the corporation itself, that might be changing the identity. However, merely adding trustees and removing trustees are not CGT or stamp duty events. They're just not as part of that. Ending a trust. This is something that people, including Gina Reinhardt, doesn't know very well. You as the beneficiary, all right, when you're presently entitled, it's your stuff. If you're not under a legal disability, you're an adult, all right, you can demand the stuff. And curiously, you can also do so if there is a condition involved in that trust. Okay, so for example, if the four of us as adults decide that, say this trust was worth, I don't know, $4 million. So we're going to get $1 million each. If you want to, you can just say to the trustee, oh, sorry, here, this is, there we go. So it's Claire, me, Maddie, and Stacey. If Claire just goes, right, I'm done with you guys. Give me my $1 million. I'm out of here. And if you can do that and we unanimously agree, so all the beneficiaries all agree, done. See you later. Sold. Here's your $1 million. And then there were 3. Okay? That's the first thing. That can happen even if the deed says, and I'm not making this up, oh, you can't dissolve the trust until the youngest person reaches the age of 31. Okay? The rule in Saunders and Vortier actually says if you are an adult, you're sui juris, in other words, you're standing to sue, you're not under a legal disability, and all of the beneficiaries unanimously agree, you can ask for the outstanding income, ask for the capital, and terminate the trust. Well, you won't terminate the trust for the rest of us, but if you were the only beneficiary, you would terminate the trust. Okay. And as an extension to that, even if the beneficiaries don't agree, you can still do this thing. So in the situation, say if Claire wanted that $1 million and the other 3 of us disagree, we don't want her to get it, she can still get it. There, though, you have to demonstrate one additional thing. You have to demonstrate that it's fungible. Fungible, you know what fungible means? It's a great word. What's a fungible thing?
No idea.
Oh, really? It's come up in NFTs, non-fungible tokens. Fungible is something which is the same as every other thing of its class. When you buy a litre of unleaded 91 petrol, you cannot tell which litre it is from that tank that you are buying. That is a fungible asset. Okay? So, if I give some examples of things that are fungible, things that aren't, see if you can categorize them. All right. So we're going to have a house, going to have an artwork, we're going to have a packet of shares, and we're going to have cash. Which of these are fungibles and which are not? Is a house fungible or non-fungible? Can you split a house up without prejudicing each other beneficiary? So if, for example, the 4 of us own a house,
No.
it is definitely not fungible. Now, technically, as Stacey would be well aware, can you sell part of a house or your share of a house, assuming that there was one house and say there's $4 million, to say it was one $4 million house. Could you, in theory,
yeah, you can sell your share or interest in it.
Yep. What do we call that? What does the legal title have to be in order to sell that? It has to be
equitable. All right. Legal title.
Legal,
I don't know.
Yeah. All right.
You're
killing, yeah. Okay.
Ask some of the accounting students law questions.
Sure. So, in order to dispose of 1/4 of this house, does the house need to be owned as joint tenants or tenants in common? Claire, actually, we did this last year. Actually, I don't know. Is
it tenants in common though?
It is tenants in common.
Yeah.
So you could actually dispose of one of those things. Now, co-owners can't stop other people from getting the house. And this is why this rule in Whakatane paper mills and Manfred and Mandrel is it doesn't work on real property, because while you can sell your share as tenants in common, you're prejudicing the others. Why? Because all co-owners have full rights to access. So if Claire and me and Maddie are still living in this house and you sell your share, some random is going to be able to come into that house. That is going to prejudice the other beneficiaries quite substantially. So houses are non-fungible. What about artwork?
No.
Correct. It is non-fungible. Why? You can't chop it up. An artwork can only be possessed by one person as a physical thing. at any given time. You can't chop it up. What about shares?
Yes.
Yes, you can sell shares independently of each other. Yes, that's fungible. And cash?
Yes.
Yes, fungible. And what about NFTs? Anyone know what NFTs are?
Mm,
Oh, you've heard of this though.
no.
You guys, you've heard it's been all the rage amongst the finance nerds.
It is it I don't like crypto or something.
It's like that, yeah. So basically, with you think of cryptocurrency, that is a ledger balance. But some you can also have encrypted just any binary data. And so you've got these people, for example, the Wu-Tang Clan made an album, okay, and they had it as an NFT, which means that they took the music, encoded it, cryptalized, so you needed to have a special key to unencrypt it, and then just sent it out into the world. There you go to it. So there's one person can own that at any given time. If someone wants to buy it, they have to transfer it away. So Ethereum, by the way, is the main way to go through and do that because it has its own currency built in. What else? The silly things, pictures of cats and monkeys and things. It just got stupid. It's just stupid. I've been at software for a really long time. NFTs are dumb. It's just a dumb thing, and yeah, it's people just spruiking them. And so the thing is with NFTs, it's literally in the name, non-fungible token. They are different and distinct from everything else. That's the whole point of them. Okay. So anyway, so there we go. Now you know how to enter trust. So if you enter trust, if those things are by, if everything is fungible and can be chopped up and you can get out of it, no dramas. Okay. Contingent interest. So if, however, we had this interest in this house or jazz or whatever have you, but we only have it or hold it for life, and then once we die, it goes to someone else. That's a contingent interest. You can't invoke the rule in Saunders and Bortier for contingent interests because it's not you as the ultimate owner. Also note that trusts have to vest. They have a vesting date, and the vesting date can't be more than 80 years. So you can't put in a trust, this trust will vest in 100 years. That will be invalid. But you can say, this trust will last until the last of us die. Now, I don't know if I've got 80 years left on this planet, but some of you might. No, in fact, let's be absolutely clear. I do not have 80 years left on this planet, but all three of you probably do if you eat and drive sensibly. Stacey's like, yeah. So there's wait and see rules.
I was thinking that. I was like, 80 more years,
right.
I don't know if I could do it.
So they use a wait and see rule. So even if it seems a little silly, wait until the last. So that if it could go over 80 years logically, they'll wait. Of course, they'll wait. And if the thing doesn't vest in 80 years, then it actually results back to the set law. So I've got to not tell my crazy vegan Marxist barefoot friend Rebecca that if my trust doesn't vest in 78 years from now, that she's definitely not living for 78 years either. That would go to her estate retrospectively. It all goes back, which is kind of neat and kind of scary. All right. After death, we did have. I've got some anti-avoidance things here. Yeah. All right. So a couple of things. If you, as the trustee, have you're dealing with the estate of a deceased person, and this is trustee, like the executor of the estate, that's treated as income. Because you're still winding the things up, they say that, look, you just do this as if it was taxed at the marginal rate of the trustee. So that is similar to what it had in that list of things that they take into account. But section 101, capital A, sort of overrides that. And it's not the trustees it's the trustees, like in their role as the trustee. It's not them as their individual margin rate. So me as the trustee of my family trust is completely unrelated to me in terms of my own marginal tax rates. Okay, revocable trust. This is the reason we have $10 trusts in Australia. This idea of this, it was to do with this case, this Truesdale case, because Parliament, in their infinite wisdom, decided to create a thing that says, look, if you create a trust and you, the person who creates it, has the power to revoke it, alter it, in order to some way get a beneficial interest back to you, either income or property, all right? If that happens, or where the income is payable to a child of the settlor, okay? In either of those situations, the tax payable by the trustee is also payable by the settlor. Let's go through that one again. If the trust is revocable, or it's going to a child of the settlor, then the settlor has to pay the same amount of tax as the trustee does. So that you basically tax twice. Why would you have that? That is a very good question to ask, Stacey. I'm glad that you asked it. It's really dumb. It's really, really dumb. And what's even dumber was good old Sir Garfield Barwick in Truesdale. Why? Because in the 70s, the early 70s, the ATO just lost the unlosable in this outrageously silly libertarian high court. You guys know what libertarian means? No? Yeah, might.
No.
No,
No,
isn't that like
okay.
an American term?
Yeah, it is, because it's very, very American in terms of style. Libertarian is where you don't believe in government. Government should just get out the people. People want to do drugs, they should just do drugs and die. That's their fault. You might remember old, anybody watch Parks and Recreation?
No.
Oh, okay, you should go and watch that. It's pretty cool. There's a character in it called Ron Swanson, something of an internet meme these days.
Yeah, when I'm not doing uni.
We're not doing uni. Yeah, there is that.
Oh,
Yeah, well,
well.
that's fine. It's the sort of thing where you're binging everything these days anyway.
Yeah.
But the person who works runs the Parks and Recreation department, but is a strong libertarian and hates government. Absolutely hates it. The idea of paying tax is an anathema. That's just why in Australia we're much more comfortable with paying tax, whereas in the United States, given that the whole nation was sort of founded on that, no taxation without representation, they have much more of a problem. It's much more of a political issue over there. It's just, I think it's just stupid, but that's the way they're culturally set up. Anyway, so libertarianism is the idea there should be very, very, very little, and government should just let people just do whatever they like. All right, tax is theft. And so the tax office lost all these cases in the 70s, and Truesdale being a hilarious one. What they said, and I'm not making this up, or the way this is written, it says a child of the settlor. Okay? So how do you get around that? So going back to a situation where you want to put your house in a trust, do you put your house straight into a trust as the settlor?
No.
No. What do?
You do the $10 thing?
You do the $10 thing. Good work. Yay, somebody was listening. Oh my God, I'm so happy.
Kind
That's
of
exactly
listening.
right.
Kind of listening. Hey, apparently.
Got it. That's it. So you do the $10 thing, and then after that, then you put the house in. Does that sound stupid? Just like a stupid rule? It is a stupid rule to get around. It was a stupid decision to get around a stupid piece of legislation. And it's still in the Tax Act. Yeah. I don't know. Anyway, that's Truesdale's case. I think there's something to shoot there as well about that. But that's revocable trust. So I'll show you a trust deed in a little bit, and we're going to go have a little look. Because if you're creating these things, and you should be using pro formas, they'll all say the settlor has no power to to do anything in regards to revoke the trust, because that would be otherwise problematic. Trust stripping. Oh, okay. So again, this is an anti-avoidance system. Apparently, and I didn't talk to Steve much about this, I meant to. If there is a tax-exempt organisation, so something like, I think is the JCU Law Student Society tax-exempt? Might be. Yeah, it might be. Either way, or it doesn't make any money. Either or. You could, in theory. So let's just say that we've got our trust, our 4-person trust. Oh, it's in a little picture. All right, we could get the trustee to distribute $10,000 to the JCU LAs. Let's just assume that they're tax-free. I don't think they are, but I should know. I was the treasurer for 3 years. So the JCU Law Institute decides, so what you could do is say, hey, how about this? We're going to pay you $10,000 income. And you go, sweet, we're tax exempt, so we're not going to worry about that. Oh, and can you make a capital transfer to gift us some smaller amount, I don't know, $9,000. Okay, and that apparently happened. So just have a $9,000 capital transfer. Bloop. What does that mean? Well, it meant in that situation that you're essentially stripping the income out of the trust. And they said that, look, if you distribute to a tax-exempt organisation in return for a capital transfer, the beneficiary is deemed not to be presently entitled. In other words, this amount that was paid, whether you pay it or don't pay it, they're not deemed to be presently entitled. And as such, you're going to have to pay a punitive rates. If you're paying amounts that where they're not presently entitled to money, because you are just distributing it outside beyond the scope of that thing there. So you pay it at 47 cents to the dollar. Okay, there's a few other things I just want to note. Bare trusts. Look, there's a certain type of trust you have where the trustee has no other duties but to pass title to the beneficiaries. Okay, that is called a bare trust. That is when you're just holding stuff until the beneficiary asks for it. And so you can have a situation, by the way, where you've got income that's been allocated to the beneficiary but hasn't been paid. You're just holding it until they ask for it. You can have that. So it's basically you've in doing the distribution, you can put it to a separate bank account. That is a bare trust. So you can go through and to have that. That's just a type of trust where the trustees have no other duties in regards to that. So that particular phrase comes up. Unit trust, these things can come up, not so much these days. Basically in the 90s, they would do this with superannuation, where you would have these trusts that are set up, but they're chopped up like companies. They're chopped up in little shares. And I worked for one of the big banks, and I was on the system that dealt with unit trust and unit trust pricing. The idea is that they can be bought and sold. You can actually buy and sell shares, so to speak, or units, they call them, in these certain trusts. And if you were buying them in some of these older ones, they had certain grandfathered superannuation tax benefits. That's why people would go through and do that. But they've removed a bunch of those benefits, and so that the unit trusts that are there out in the world that you can buy and sell, they're not increasing in number dramatically because those tax sort of loopholes got fixed. Finally, the thing that I was just asking Stacey just as we started this class is the LPA. Look, solicitors have a certain type of bank account called the solicitors. It's just called a trust account. There are a variety of different types. The general trust account is the main one that all law firms must have, and that is where they must be paid into, and you cannot draw upon that unless you jump through a whole bunch of super strenuous, strict rules in order to do that when clients have been paid. The idea is that clients for law firms prepay most of the time, and you give advice, and then once that's been done, you properly go through, create a bill, invoice, and then you remove money from the trust account when that's done. Key thing to note, and this used to be really dumb. These days it's all done through the ADIs themselves, the banks. It's got approved deposit taking authorities. You can look that up, that phrase. It'll come up in advanced tax. It just means banks. The big banks are ADIs plus a few other entities. There's about 40 of them. And 40, 20? 20. When I did trust accounting as a law student, we had to calculate the amount of interest because hilariously, it then had to be calculated, then paid to the state government. These days, they've just organised it that trust accounts, special bank accounts that just don't earn interest. The idea is that the state government keeps that.